Hello and welcome to today's webcast titled Precious Metals, Rebalancing in Unbalanced Times. We have just a few announcements before we begin. The slides will advance automatically throughout the presentation. Should you need technical assistance, click on the help link. If your screen freezes or the slides do not appear to be advancing as they should, please try exiting and restarting the session, as it may be an issue with your connectivity. At any time, you can submit a question using the Ask a Question box located in the bottom left-hand corner of your screen. I will now turn the call over to Sonia Duray with Kitco Metals. Please go ahead.
Welcome. Today's coffee break presenter is Jon Nadler. With over 35 years of experience in the precious metals industry, Jon writes analyses and columns for Kitco, which are often quoted by renowned media. He is one of the Internet's most frequently quoted precious metals analysts. Jon established and managed several very successful retail investment precious metals operations at Deek Pereira, the Republic National Bank of New York, HSBC, and the Bank of America, NTNSA. So enjoy the presentation. Over to you, Jon.
Thank you all for joining me for this Kitco Coffee Break webinar. I have some interesting things to relay to you all today, and we'll be certainly taking questions directly and by email following the webinar. Now, we've all heard of the necessity to diversify investment portfolios in order to enhance returns and to spread risk over a broader spectrum of assets. Here, you see a basic construct for a reasonably well-diversified basket of wealth. You will note that attention is being paid not only to including equities and fixed income instruments, but also to geographic diversification and to the inclusion of alternative assets into the investment equation. However, many successful money managers also know that the act of bringing a portfolio that has deviated from a client's asset allocation targets back into line is an essential periodic strategy. The process of selling certain overweighted assets and using the proceeds to purchase other, perhaps underweighted assets has proven to be a wise course of action over the years. This is because as time passes, an investor's originally intended asset allocation does shift into a different and often less desirable direction as certain assets perform while others do not. Often, a portfolio that was built to be conservative may actually become riskier, owing to such distortions. One of the commonly used rebalancing strategies is to bring a portfolio back into line any time a particular asset's allocation deviates by more than 5% from the originally intended equation. The same methodology also applies to gold, of course. Once a core insurance allocation in gold has been established by a retail investor at generally around the 10% level, it might be beneficial to revisit that holding from time to time in order to ensure that its presence in the portfolio is not excessive or perhaps insufficient. The bull market in gold that has taken place since 2001, and especially so since 2008, has very likely changed the original profile of many an investment portfolio in precious metals, perhaps even without the owner of such a basket of wealth realizing the benefits, opportunities, and indeed certain dangers that such a change has brought with it. With the noticeable shift in gold's decade-long trend since last September, many of our clients and customers have begun asking some very basic questions about their investments. I would submit to you that it is time to take note, take stock, and probably take action for many individual investors at this juncture. Take, for example, Mr. and Mrs. Smith, who were wise enough to allocate a 10% portion of their $1 million basket of assets to gold back in early 2006. At the time, they spent $105,000 and bought 200 ounces of gold at $525 an ounce and started to get a better night's sleep after that fact. Now, however, our happy couple, after 6 excellent years in the gold market, finds itself owning $320,000 worth of gold and, more importantly, with their portfolio still only worth $1.2 million because they didn't do very well in real estate or stocks, the gold allocation has now swollen to represent 27% of their estate. This is not necessarily a good situation. Let me explain. The 300% or more gain that Mr. and Mrs. Smith have not realized any portion of is like money in the bank. And unfortunately, I mean that literally, as banks pay practically 0% on deposits these days. So what are some of the options on the table for Mr. and Mrs. Smith? Well, for starters, taking $200,000 worth of metal off the table would allow this couple to, first of all, keep 75 ounces worth $120,000, or 10% of the current value of their estate, at a no cost per basis ounce. Taking the same $200,000 and buying, for example, palladium, platinum, or rhodium with it could offer potentially lower downside risk, as well as potentially higher percentage potential returns over the short to medium term, especially if there's a cyclical change in the making in the gold market, as some analysts believe. Platinum and palladium are still considered to offer positive supply and demand fundamentals and to play an indispensable role in the world's modern economies. Investors have begun rounding out their gold and silver portfolios with the so-called noble metals as a matter of necessity. This is not some kind of diversify or die panic-driven investment, but rather a diversify the pie, prudent and potentially profitable and well-calculated move. We have, for example, seen at least a couple of forecasts calling for $2,100 palladium in the 3 to 5 years time window based on tight supplies from South Africa, basically exhausted official Russian inventories, and on robustly growing global auto sales. It is then worth asking the question whether it might be easier or more likely for palladium to reach such a number, or for gold to climb to more than $5,600 within that same time frame for a move of an equal size in percentage terms. If our hypothetical couple had the inclination to trade metals on a more frequent or short-term basis, they could also consider investing in silver. Over the past several years, there have been numerous occasions upon which one could have purchased the white metal and realized a quick 5 or 10% gain over a relatively short period of time. Of course, discipline and specific buying and selling targets would have been essential to observe, but the point is that the opportunities have been there. The benefits of such action are obvious. Most importantly, the rebalancing of the Smith portfolio brings the gold component back in line with the couple's original objectives, and it removes a good deal of potential volatility from the asset pie by virtue of the reduction of the allocation from what would normally be considered an overweighted situation. The rebalancing process thus keeps everything that should be present firmly in place, but it also allows for a good deal of newly created investment capital to be put to work in areas that might offer good and or better returns from this point forward. Therefore, with gold and silver at potentially pivotal points in the wake of almost non-stop gains over the past 11 and a half years, it might be a very good time indeed to sit down and take stock of one's basket of investments. One might discover that perhaps they own too little gold or that they have too much silver. They might tally a handsome but unrealized gain in silver, or they might find that their gold was acquired at a sufficiently higher price that a cost-averaging purchase and the reinstatement of the 10% core allocation might be in order. The point is that a thorough inventory, if you like, of one's holdings will likely reveal some items that need one's attention. And with all of that above in mind, I would sincerely urge you to contact the expert representatives at Kitco and discuss with them the status of your account and the many possible options you have at your disposal at this uncertain time in the marketplace. Trust me, you will be glad you did, and your money will thank you by hopefully multiplying further. They often say that the key to life is balance. I would certainly extend that maxim to include your financial life as well. Rebalancing in such unbalanced times might prove to be the best strategy for long-term success.
Thank you, Jon. Now I'm going to go into some of the questions that we've received from members of the audience. Here's the first question. Any insights for rhodium supply and demand?
Well, rhodium is a very specific and unique situation because the metal is produced essentially as a byproduct. There is no primary rhodium mine in the world in existence. So the mine output of this extremely important and noble metal is fairly insensitive to prices. We have, however, arrived at a situation where in recent years, fabricators, essentially the auto industry, which witnessed a sharp increase in rhodium prices to roughly $10,000 an ounce, began thrifting the metal, in other words, looking for ways to substitute expensive rhodium with less expensive metals. And the level of automobile sales in Europe, given the European crisis, as well as in China, given its difficulties on the economic front, had been less than what market analysts had expected up to a point. That said, the surplus situation in rhodium is expected to commence shrinking in the period of roughly 2013 through 2020, and rhodium prices, which are currently hovering at between $1,000 and $1,100, are expected to show a potential increase of up to 40% on an average annual price basis going forward. So we shouldn't be surprised to eventually see roughly $1,400 rhodium down the road.
And what is the best metal to fund my IRA-proof gold or bullion?
Well, to that listener, I would say first and foremost that if you're contemplating a IRA account funding with metal, specifically gold, you should be looking for three attributes that are essential. First and foremost, value for money. You really would like to have the largest possible amount of ounces for each dollar you spend. Second, what you want is a safe custodian holding your IRA trust account and managing it. Last but not least, you want instantaneous liquidity, which is very much essential at a time when it becomes time to mobilize part or all of this IRA account. Unfortunately, proof coins, anything proof, doesn't fit pretty much two out of the three criteria. Namely, their premiums are extremely high. You end up spending well over $2,000 or possibly $3,000 an ounce per ounce of gold. You end up with a product that is highly subjective, opinion-based when it comes to valuations and appraisals, and the grading system is basically far from perfect. And last but not least, this might impair your liquidity when you go to sell such items. So for my money, if I funded an IRA type of account, I would stick to ounces of gold in the form of ingots or coins that are acceptable by the guidelines in the IRA accounts, and spend the least possible to do such an allocation. And
the last question for today, is junk silver a good way to go in the metals market?
Well, if the basic premise is that someone wants to participate in the highly volatile silver market to begin with, then yes, it is one of the ways that you might participate in the silver market through. That said, the basic objective, just as I mentioned with the gold IRA allocation, should be that you spend the least possible per ounce of silver for your money, and that means that you're looking for the lowest premiums items out there. Silver bags, silver junk bags as they're called, contain about 715 ounces of silver. They're all pre-1965 U.S. coinage in the form of dimes, quarters, or half dollars. And the basic content vis-a-vis the current retail price would suggest that these bags are trading at about the 3.3% premium over and above the price of silver. Not a bad premium by any means, certainly cheaper than 1 ounce eagles or maple leafs. However, do bear in mind that there are less costly products in silver which you can acquire, and Kitco does offer them as well. And I would refer to 1,000-ounce silver bars, which are selling for basically half that premium at about 1.5%. Perhaps 100-ounce silver bars, which are not too expensive either. And finally, the Kitco silver pool accounts, which are really the actually most cost-efficient basis to get into silver with, trading for basically only 1% above the asking price of spot silver on a given day. That is the product that would enable you to have the fastest break-even proposition if you decide to participate in the silver market. Junk bags are perfectly fine for those people who wish to fondle their silver, if you like, and hold on to something that could be used as a barter medium or as a currency. Ultimately, this is specifically currency, but it is just one of the available ways to invest in the silver market.
Thank you, John, for the informative presentation, and thank you all for attending today. Kitco will be happy to assist you with your precious metals needs. Please do not hesitate to contact us at 1-877-775-4826. Kitco will be hosting another free 15-minute coffee break webinar in September, so please keep checking our website for more details.
Thank you all for your attention today, and please feel free to contact me directly with any questions or concerns you might have about this or any other related topic in precious metals. My contact information is jnadler@kitco.com, or you may call me toll-free at 877-839-8036 during business hours, and I'll be happy to take your call. Have a great day, and thanks again for coming.
Ladies and gentlemen, we thank you for your time and attention. This webcast is now concluded.